What if there was a simple mathematical formula that could tell you exactly when your money would double? What if you discovered that most wealthy people already know this secret, but they rarely talk about it? Today, you're going to learn the Rule of 72, a powerful financial tool that has been used for over 500 years to build extraordinary wealth. Albert Einstein supposedly called this rule more important than his theory of relativity. Whether he actually said that or not, one thing is certain: this rule can completely transform your financial future. By the end of this video, you'll know exactly how long it will take for your investments to double, and more importantly, you'll understand why starting today is absolutely critical. Before we dive into the Rule of 72, please subscribe to Grow with Indus channel for more personal finance content. Let's address the elephant in the room, the salary trap that keeps millions of people financially stuck. Here's the harsh reality: your salary is designed to keep you comfortable enough to stay, but not wealthy enough to leave. Think about it. You work harder each year, you might even get a raise, but somehow your bank account doesn't reflect all that effort. The bills keep coming, the expenses keep rising, and at the end of the month, you're left wondering where all your money went. This is the salary trap in action. It's not about how much you earn, it's about how much you keep and how much you make your money work for you. Even people earning substantial salaries often live paycheck to paycheck because they never learned the fundamental principle of wealth building. Your money should be making money while you sleep. The problem isn't your income level. The problem is thinking that your job will make you wealthy. Your job pays your bills, but only your investments will make you truly free. What is the Rule of 72? Now, let's talk about the game changer, the Rule of 72. The Rule of 72 is elegantly simple. Divide 72 by your expected annual return, and you'll get the approximate number of years it will take for your investment to double. The formula is years to double equals to 72 divided by interest rate. For example, if you invest money at an 8% annual return, your money will double in approximately 9 years. If you get a 6% return, it takes 12 years. If you get a 12% return, it takes just 6 years. This isn't just theory. This is the exact calculation that wealthy investors use to plan their financial future. They don't guess about when their wealth will grow. They calculate it precisely. The rule works because of compound interest, the eighth wonder of the world. When you earn returns on your original investment, plus returns on your previous returns, your money grows exponentially, not linearly. Real-life application of the Rule of 72. Let's see how this plays out in real life with some practical examples. Imagine you have $10,000 to invest. Here are your options. Put it in a savings account, earning 2% annually. Your money doubles in 36 years. Invest in government bonds at 6% annually. Your money doubles in 12 years. Invest in a diversified mutual fund, averaging 9% annually. Your money doubles in 8 years. Invest in growth stocks, averaging 12% annually. Your money doubles in 6 years. The difference is staggering. In 36 years, the savings account turns your $10,000 into $20,000. But the growth stock investment turns that same $10,000 into $320,000 over the same period. That's 16 times more wealth. This is why the wealthy think differently about money. They don't just save money, they strategically place it where it can work hardest for them. How the wealthy use the Rule of 72. Here's where it gets really interesting: how wealthy people actually apply this rule to build massive fortunes. Wealthy individuals use the Rule of 72 to make strategic decisions about their money. They ask themselves, will this investment double my money in 6 years, 10 years, or 20 years? Then they choose accordingly. For instance, if someone starts investing $1,000 per month at age 25 with a 10% annual return, their money doubles every 7.2 years. By age 65, they would have invested $480,000, but their account would be worth over $6 million. That's the power of compound growth working consistently over time. The wealthy also use this rule to understand opportunity cost. They realize that keeping money in low-return savings accounts isn't just safe, It's actually risky because inflation erodes their purchasing power over time. Most importantly, they understand that time is their greatest asset. Starting early gives them more doubling cycles, which translates to exponentially more wealth. Where to invest for fast growth? Now that you understand the rule of 72, let's talk about where to actually put your money for optimal growth. For aggressive growth, targeting 10 to 15% annual returns, consider growth stocks in technology and innovative companies. These can potentially double your money every 5 to 7 years. Diversified equity mutual funds, historically averaging 10 to 12% annually, doubling your money every 6 to 8 years. Small cap funds, higher risk but potential for 12 to 15% returns, doubling money every 5 to 6 years. For moderate growth, targeting 7 to 10% annual returns. Index funds tracking major market indices, typically doubling money every 7 to 10 years. Balanced mutual funds, mixing stocks and bonds for steady 8-9% returns. For conservative growth, targeting 5 to 7% annual returns. Dividend-paying stocks, providing both income and growth, doubling money every 10 to 12 years. Real estate investment trusts, REITs, offering exposure to real estate markets. Remember, the key is not just picking high-return investments, but creating a diversified portfolio that can weather market fluctuations while still achieving solid long-term growth. The most successful investors start with low-cost index funds and gradually build more sophisticated portfolios as they learn and their wealth grows. Taking action. Your 72-hour challenge. Knowledge without action is worthless. Here's what you need to do in the next 72 hours to start applying the rule of 72. Day 1. Calculate your current financial position. Take every dollar you have in savings accounts and calculate how long it will take to double at its current interest rate using the rule of 72. This will likely shock you into action. Day 2. Research and select your first investment vehicle. Start with a low-cost index fund if you're a beginner. Most brokerages allow you to start with as little as $100. Day 3. Set up automatic monthly investments. Even if it's just $50 per month, the key is to start. Consistency beats perfection every time. Remember, the rule of 72 rewards those who start early and stay consistent. Every month you delay is a month less of compound growth working in your favor. The wealthy understand that building wealth is not about making one perfect investment. It's about making regular, smart investments over a long period and letting the rule of 72 work its magic. Your future self will thank you for starting today, not tomorrow. Because in the game of wealth building, time is the most valuable ingredient, and the rule of 72 is your roadmap to financial freedom. Please subscribe to Grow with Indus channel for more personal finance content. We will help you turn financial knowledge into financial freedom. Please share this with your family and friends who are interested in personal finance.